Thanks for the intro, and thanks for having me for this session. So I'm just going to share my screen, and then just make sure that everybody can actually see it. So, quick thumbs up if you can see it. All right. So a few thumbs up here and there. Awesome. Okay, great. So before I get started, a little bit about my background. So yes, I've worked with Nefis for a long time now. Was at the DMZ Investor Relations, and then I briefly served as a senior analyst at Scale Ventures, where I worked with one of the partners there, Matt Roberts, and now I'm at Silicon Valley Bank, essentially as their senior market development manager. So what that means is I've been sort of helping Silicon Valley Bank expand here in Canada over the last sort of 6 months of my time with them through three different ways. The first being sort of like the way we partner and we work with the different sort of accelerators and incubators across the country. The second way is essentially partnering with the different conferences and events across the country, which is now a little challenging due to COVID, but finding new and innovative ways to kind of still deliver meaningful content is in our DNA to always kind of just like innovate and change things and adapt. And finally, sort of also leading the early stage practice as well. So how do we actually best serve and how do we help founders at the early stage? Which I can actually talk a little bit more about sort of like in the question answer type thing. But so we can actually get into this. There we go. Agenda, just going to talk a little bit about SVB, and then we're going to talk a little bit about sort of like what's happening on the venture capital side from a macro to micro lens. So we're going to go from like a global down to sort of like the street level here in Toronto to kind of talk to you about like what's happening and kind of cover the different perspectives. Through that or in that journey, essentially, I'm going to be talking about sort of like how venture capital works. So there's a little bit of a VC 101 going on in there. The reason is because I'm trying to paint a picture as to why and how a VC thinks. And that way, sort of like put the pieces of the puzzle together as to how VCs are thinking right now. So why do they consider deals when they do? How do they look at the market? And essentially tying that piece with sort of what's happening right now with COVID should help you guys sort of build this picture or a clearer image of what's going on with VC. And then we're going to talk a little bit about like how that's actually affecting their deal flow and how that's affecting their sort of like valuations, their thoughts, their investment strategy, etc. And then also on your side of things, as a founder, what you guys can actually do. And then we'll talk a little bit from our perspective as SVB towards the end. And then Q&A, obviously, just as Nefis said, just pile them into the chat and then we can sort of like tackle them there. So an introduction to sort of Silicon Valley Bank. We were established in 1983 in Santa Clara. Think of us as a bank with startup in its DNA. We are essentially a financial institution that is geared towards startups, that being startups are our key client. Unlike your traditional VCs, TVs, etc. Our main clientele are technology companies. And you can see at the top there the sort of like the different sectors that we serve. So hardware, infrastructure, software, life science, healthcare, energy, resource innovation. And then we even bank some VCs as well, because we actually have a lot of overlap with their clients. And we kind of grew into sort of helping bank them as well. And then the sixth one is sort of like the odd one, which we talk about every once in a while, which is the premium wine sector. That's just a very good sort of example of follow your customer. So we've had a lot of clients that have had, very healthy exits. They wanted to go into winemaking. They wanted to buy their own vineyards. We kind of just followed them there because we already had the relationships. Sadly, there's no premium wine clientele here in Canada just yet. This is just in California for now. But to kind of give you a 30-foot view, 30,000. So from a global standpoint, we've got around sort of 25,000 clients. 4,000 of those are in life sciences and health. And we've got about like 3,000 plus venture capital clients as well. And from the map, you can see there in the corner, we're in about 9 countries and about 40 cities worldwide. And that includes like our headquarters, representative offices, full-on operations in countries, etc. And then you can kind of see the countries down at the bottom of this slide here. These are just some sort of like stats about the bank as of December 31st, 2019. We've been around for a while now, so since 1983, and essentially because we've been working with startups for such a long time, because we've actually worked on building these relationships from the ground up, and really sort of putting ourselves as a good ecosystem player and as like a good founder backer as well. We've actually been able to manage. We've actually managed to take the market share in the States. So approximately, so 50% of all venture capital-backed tech life sciences companies in the States are clients of ours, which is kind of crazy to think of the scale. But this is what happens when you really put yourself when you really think of like founders first, helping them, championing their causes and being there with them or being there for them through thick and thin. So, brief look on Canada. These are some of our clients here. We've got many more, but these are sort of like the prominent ones that we kind of like wanted to highlight. So, Drop, Shopify. We've got Rent a Run in Montreal. That was a company that we worked for. That is also a scale-up for a ventures company. Funny enough, seeing it there. Borrowell, Snap Travel, Majuri, etc. Wave Accounting, and then there's Vantage Capital. So we actually do some work with some VCs here as well. So, going into the main topic itself, so it doesn't need to be sort of restated as to how devastating this entire sort of ordeal has been on both sort of economic and health sort of aspects of life. You're seeing travel restrictions, you're seeing cancellations, you're seeing flights getting upheld, you're seeing all sorts of like industries die out, get held, freeze, lose their customers, all sorts of disruptions. So entire industries have actually slowed down to a crawl. Some have been completely wiped out in the sense where they've been deemed non-essential or essential versus non-essential. Where you could be a company that your clients all of a sudden are no longer in business. So it's not about churn. It's just about that your market is now gone, which is something that I think most companies just weren't really prepared for. Couple that with supply chain disruption, and you've got a recipe for disaster for some startups. On the Canadian sort of side, so zooming in a little bit more, looking at like a countrywide perspective, you've seen the Bank of Canada step in, cut rates twice. So first to the 0.75% and then down to the 0.25%. The entire aim was to make lending a little cheaper to help economic activity. The BDC started all sorts of different small business lending programs. The wage subsidy program was introduced. And then there was the whole back and forth, if you guys remember, in the beginning of March, April, on like how eligible tech companies were or were not. And then thanks to the Canadian Council for Innovators, you actually had some lobbying with the government, which actually opened it up a little bit more. On the provincial level, you've had the aid packages be announced, $7 billion for direct support, and then $10 billion for sort of tax and tax-related deferrals. And then obviously you had the whole issue of essential versus non-essential businesses. Going from there, there's been a lot of updates to this. So this slide is slightly outdated. There's been more developments there. And on the tech industry side of things, it's been felt by everybody. Startups have shut down, organizations have frozen, some have had to close their doors. Programs, a couple of weeks ago we saw the news with 111. That was most unfortunate and like completely unexpected. Conferences have had to stop, either had to completely cancel or go to like a virtual setting. But the good news here is the community actually stood together and they kind of like rallied to help. So you had a few good examples of some startups sort of like rallying to the cause. So Rescue, for example, Toronto-based company, immediately started a business where they were delivering food to frontline workers. Nix, I think, started a GoFundMe page to actually set up and make sort of protective personal equipment for all sorts of people as well as frontline workers. So you have like really good cases here and there of startups sort of stepping in and wanting to help out. And I think that's one of the greatest things about the tech community here in Canada, is that people were willing to step up to the challenge and sort of step in, help out, really come together during this troubling time. And you've also seen sort of like other organizations pop up that were trying to aim at helping people who were suddenly unemployed. So one of the main things that I remember was Prospect.fyi set up a Google Sheet for those that were suddenly unemployed, and then all of a sudden that sheet became too big for Google to actually handle, that they actually had to move it to a website and actually build a platform out of it. So looking even further at these perspectives, the main one for today that we're going to be talking about is the central column, which is VC. So I'll get to that one in a bit. But on the traditional lending side, you'll start to see a lot more banks become hesitant to lend or to do business with smaller companies, specifically startups, just because startups by nature don't have a rhythmic or consistent revenue generation engine per se. Not until you've hit your sort of post-seed or Series A stage. So the lender focus and their priority starts to shift away from you. They start doubling down on the familiarity versus the unknown. This is actually a trend where it's just going to hit everybody anyway. So familiarity is what people are going to double down on, just because, again, it's what's safest and it's what makes most sense economically speaking. On the program side of things, you guys here with YSpace, you've had to, YSpace has had to move, for example, virtual. Selection, intake, that all becomes sort of heavily impacted. Funding sources from the government also start to become a little bit sort of tighter, just because the government is now trying to divert funds into either trying to save small businesses or, putting them into other initiatives. But to kind of see programs pivot and go into virtual and still offer the programming that they would have in a physical setting is actually great. So I would say lean on these support systems. We need more Y spaces. We need more sort of DMZs, Techstars, LSparks, etc. Because at the end of the day, these are the programs that are going to help support you guys through these tough times and get you all those resources that you actually need to build your businesses. So for VC, I'm just going to go through some really quick bullet points on this one. I'm not going to go through the whole column, but essentially the criteria rises. So whatever they were talking about a few months before COVID hit is now raised. The bar is now up, right? They're looking for high performers now. They don't really care about anything else. It's companies that are really sort of generating and sort of growing and growing really sort of fast. Familiarity versus unknown, it's still in there. The power law kicks into high gear, where 80% of their returns come from 20% of their portfolio. That's something that's going to become truer than ever. And we'll talk about that one in a bit with regards to where you stand in a portfolio for a VC, should you have VC funding. On the valuations and exits front, public markets are down, which means IPOs aren't really sort of happening anymore, which means on the private market side of things, when you're looking at valuations, those are now lowered. You will start to see more acquisitions happen, I think, over the next 3 to 6 months. Down rounds may occur where you're actually raising at a lower valuation. You're going to start to see VCs institute more protections against you and for themselves in rounds. So you're probably going to start seeing more more stricter terms. And the number of boards managed is just going to start to increase as they try to triage their portfolio companies. Because when this thing first hit, one of the first things that happened was VCs almost immediately went into triage mode with regards to their own portfolio companies, trying to figure out which ones were on fire and which ones were not. And that meant that they had to, look more internally rather than externally towards deal flow. That's just how it was prioritized. So to go into it, let's take a step back and try to understand what VC is to begin with. So venture capital in itself is a mechanism. It's there to fill a void. Specifically in the company's life when it begins to commercialize its innovation, right? It's after you find your product market fit and now you're trying to grow. The reason why it exists in that specific sort of awkward teen phase for a company is because usury laws, lending laws for banks in most countries don't allow banks to operate that early, and banks, in and of themselves aren't really likely to kind of lend towards like shaky companies in the beginning. The idea is to fill this void successfully, VCs, they need to show a few things. So they need to show that there's a sufficient return on capital, because guess what? Just like you raise, VCs also have to raise. They have to raise from their LPs. So to be able to raise their funds successfully, they have to show that there's a market for this, and that this market is going to generate these really attractive returns. And it's going to show attractive returns for its own participants, for its own sort of GPs as well, for their own portfolio. And the entire idea is they also need to show that there is a upside, or there's a sort of like an attraction as to why a portfolio or a potential company should join their portfolio rather than some other VC's portfolio. So there's a lot of sort of satisfaction and a lot of like attraction that they actually have to show. So in short, they have to earn a consistently superior return on investment in a very inherently risky business, which is not easy. So there's a few links here where you can kind of read more about this. I highly, highly, highly recommend that first link where it says how venture capital works. Yes, it's an old paper from Harvard Business Review, but I think this is one of the stronger sort of like papers. It kind of stands the test of time in terms of basic theory for VC and sort of like the economics of investing. The examples it uses are outdated. It talks a lot about the cloud, and it talks a lot about CD-ROMs and floppy disks and whatever, which I think is kind of funny, but the basics are there, and I think it's actually like one of the better papers out there about like VC 101. Anyway, so how does it actually work? It's a fund that at the end of the day is sort of like managed by experienced operators and investors. And as I said before in the previous slide, the fund comes from institutions, corporations, and high net worth individuals. These are the LPs. So at the end of the day, the VC that you talk to, the partner, the associate, all of it. And the goal of the fund essentially is to pick winners, earn a healthy return on risky investments, just as we said before, right? I'm putting money into a company because I want an equity stake, and just as we said, there's a power law that kicks in here where you will notice, and there's actual sort of statistics on this where it's like 80% of your return comes from 20% of the portfolio. And on top of that, out of 10 investments, 6 generally don't do so well, 3 are modest, and you have that sort of one rock star that turns into the unicorn and really sort of like moves the dial for you and really sort of generates that return. And the general formula for fund returns, so I'm not going to delve into the math here, but there's that link there where it says Tomer Dean, TechCrunch 2017. He actually walks you through the examples of how returns work and what returns are actually sort of like attractive for an LP, for a VC, and how it basically should be going forward. And then there's a bunch of sort of like additional readings in there where it kind of tells you about the different stats and how many deals an investor needs to make to find a unicorn. Anyway. So when does it come in? We mentioned it comes in at the awkward teen phase of a company when they first begin to capitalize, or when they first begin to commercialize on their product. If you look at the graph that's on the left, they come in at where it says first, second, where it's at the early stage. That's where the VC sort of comes in. The entire idea is they're trying to get in on that steep curve, put in money, get a stake in the company, and then exit at just the right moment, right before that curve starts to flatten out. And here's why I emphasize that Harvard Business Review article so much. It's just because the graph on the right is actually from that 1998 article. And if you'll notice, they're actually the same graph that highlight the same period where the VCs actually invest. So if you were to remove that black shroud on where the right graph is, you would actually see the first, second, third mezzanine steps, and you'd actually see early stage, later stage. And it sort of highlights as to the different sort of scenarios. So VCs will tend to come in, invest, and then try to exit right before the curve starts to flatten out. just because that's where they can make their highest return. So you can see sort of like the winner scenario where it's sort of like ends on an upward trend, sort of a end on a high note, if you will, rather than, you know, the loser scenario at the bottom where it's like, you know, just starting to flatten out, where your returns just aren't as high. Because that's sort of like what leads to the road to like an IPO and sort of like the later rounds as well. So where do they invest, and basically how do they think? So it's a lot about market profile and timing. So if, you know, just recalling those two graphs that we just saw in, you know, in the previous slide, you'll see that the steeper the curve is, the more attractive the, you know, the investment is to the VC. And I know I'm walking you through a 101 right now, but you'll know why in a bit. So there's a question here that needs to be asked where it's like, do VCs invest in founders? Yes, but there's a but and there's an asterisk. The entire idea is that they're investing in those steep curves, right? And they're looking for high potential founders within those steep curves. So if you're a really great founder, but you're operating in a curve, if you're operating in an industry where the curve is essentially more flat, or is a little bit sort of like flatter or not going up as fast, that's not really attractive to them. Yes, they invest in founders, but in that specific case, they're not really looking to kind of like do a deal there. And they're really looking for that adolescent period of the market where it's really starting to grow. However, it's characterized as having many companies with the same similar product or offering. And this is where the founder philosophy sort of comes in. This is where the I invest in founders that you typically hear sort of actually comes true, where many companies all serve the same, you know, pretty much all offer the same product or service, and then essentially they're looking for that talent differentiator because they're looking for that right combination of team, right combination of founders and senior leadership to actually take them to the road to the public market and get them that exit. So that's sort of like where and how they invest. So we've talked about the curve. We've talked about how they look at it. And we talked about like how they consider things with regards to power laws, statistics, industry curves, etc. So when you now take that information and you look at the COVID environment that we just talked about, where industries are now slowing to a crawl, there's, you know, you're having, you know, customers be wiped out in an instant, you know, due to them being deemed non-essential, or, you know, having things shut down or having entire industry sort of crash. You can kind of now see how VCs are currently looking at the market, and it's just not a favorable one, right? Now is not a great time for VC unless that VC has set up a fund that tackles COVID, which is few and far between, right? So we'll notice that for prospects, the selection criteria is now up. You know, they're less likely to sort of like make new investments now, more likely to kind of do follow-ons and reinvest in portfolio companies. Traction now becomes a key more than anything. The importance of signaling. So if you are actually able to rally more and more investors into your round and sort of send that signal to further VCs, that's actually a good thing. It's actually a vote of confidence that in these harsh and unknown times, that people are willing to back you up and willing to invest in your company. But generally speaking, just deals are just going to slow down. Like nothing's really going to move as fast. You know, on the valuation side, you're going to start seeing lower valuations when you're trying to negotiate a deal. And again, you're just going to start seeing more acquisitions, and you're going to start seeing tougher terms in your term sheets that are coming your way. In the third column, I didn't really know what to call it, so I just called it logistics in real life. I'm not too sure. The one thing that you're going to start to see is you're going to start realizing that communications between you and the VCs, you and the angels that you're speaking with, are now starting to slow down. And it's not because they're ignoring you. It's not because, you know, like they don't like you or like any of that sort of thing. It's just because, like you, they're being inundated with other founders, and they're being sort of like, you know, flooded with requests for funding from their portfolio, referrals, other VCs bringing deals to their inbox. There's just so much going on right now in the world that making time for new deals, making time for new founders becomes difficult. So think about that from the logistics side of things. It just becomes tougher. And then also just couple that with just the way a VC behaves, just as we spoke about in the last few slides on this is actually how they consider deals and this is how they think economically speaking. And you can kind of see why it starts to slow down and why they're just so hesitant to kind of take the second, third, fourth call, etc. On the portfolio side, you're going to start seeing that they're going to, they're going to start sort of doubling down on their higher performers. So speaking about this from my own, from my own personal experience, at Scale Up, we just essentially had a board where we had, all our investments, and we essentially had them ranked. These were the group of companies that were outperforming. These were the companies that were just doing okay. These were the companies that were underperforming, and then these were the ones that were distressed. And essentially, in these troubled times, when you're looking at your own reserves and your own sort of like second investments, and you're doubling down on them, you're trying to pretty much pour your dollars into the ones that are higher performing, and the ones that you know for sure are going to survive this. The distressed category and the underperforming category just essentially becomes a write-off. And as cold as that sounds, it's just the economics of the situation. This is just how capitalism, I think, works in the end. There's a really good article written by Scott Galloway. It's not linked here, where he talks about sometimes companies unfortunately close, and that's just how capitalism works. And he talks about his own sort of venture shutting down at one point, being like, yeah, it shuts down, and then life continues normally. And then things just keep going. And if you're a VC-backed company, so if you happen to be on this call and you have an investor on your cap table, try to figure out where you are in that ranking and try to see if they will support you through thick and thin. And if that's the case, great. If that's not the case, start talking to funders. Start figuring out your contingency plans. So, as a founder, what can you do right now if you're trying to, raise capital, if you're trying to survive this? So if you're raising, try to close your round as fast as possible. If you want to raise, I would suggest in the short term, don't, just because the valuations are probably just gonna like bite real hard, and the terms are not going to be as favorable. If you really do have to raise, try to raise as little amount as possible. Try apply for grants, try apply to different programs, try to cut burn as much as you want, or sorry, not as much as you want, as much as you can, sorry. But with regards to spending and burn cuts, remember this: if you're going to cut as few, however, as deep as you can. If you start cutting too much into your company, you will eventually break morale. And that essentially starts creating a climate of fear and paranoia within your own sort of staff. So that's something to watch out for. And also seek help, both professionally and sort of on the mental health aspect, with your peers and your and with your peers and colleagues essentially, and with these programs, because letting people go or doing sort of drastic decisions where unfortunately, if you have to wind down your company, you have to send people home, that sort of thing, it's not easy. It takes a toll. I've seen it happen with founders. Talk to each other. Also, talk to each other before you take any of these any of these measures. Just because sometimes you might not see that there might be a different alternative or a different way for you to do so. This is something that you need to kind of like make sure, and that's why honestly just communicate, and be transparent with your peers, with your founders, with your family, with your loved ones, etc., and with your funders especially. There is a lot to be said on figuring out what controllable and uncontrollable elements are there for you as a founder and your company. What kind of things can you control, and what kind of things can you sort of like shrink the burn, or sort of become, or sort of like trim the fat and sort of become like a more leaner startup, versus things you can't control. So for example, you can control who you sell to, but you can't control the market that your customer operates in. So think about those different things. There's two links here, right, under the controllable versus uncontrollable elements. I think these two articles are Paul Graham, if I recall correctly. They talk about like what kind of company you are. So essentially, those that are going to survive COVID, or those that survive economic downturns, are usually ones that have very lean sort of like business models, and these are ones that actually have working unit economics. So if you're the type of company that just exists that's looking to raise another round while you perfect your unit economics, odds are that's not going to turn out well. Odds are you need to sort of like pause for now, rethink your operations, and rethink how to actually become profitable. Because these are very tough times, and the worst problem is we don't know how long this is actually going to last either. Going to the next slide. Here's the sort of like the upside to this. So yes, we've seen that capital investment during these cycles, like during the last sort of two recessions. So you see 2000, 2002, and then 2008, 2009. They do dip, but then they tend to sort of like bounce back. We've seen the bounce back from 2009 up to over the last 10 years be pretty great. Valuations as well tend to sort of like bounce back as well. So there is a little bit of an upside there, but this is also to highlight the fact that you're going to see them decline. It's not a case of like if, it's a case of when and how, and by how much. It's not a case of like, oh no, well, like I'm going to be able to argue something better for my company. If you are great, you're probably an anomaly. But the general trend is that the capital invested is going to go down, and the pre-money valuations is also going to go down. This is just what the data shows us. However, the bounce back from it is we get really good companies coming out of these crises, right? So we've seen companies formed in the aftermath of the dot-com crash, and we've seen many of today's top companies that were formed in the last sort of recession, right? These are some of the biggest tech companies now on the planet, and they're doing phenomenally well. They're kind of growing. Some have been hit now by this new sort of economic downturn, but that's only because it's an economic downturn plus a pandemic, something that we've, in fairness, have not had before. But this is where we start to see, hopefully coming out of this, a new generation of tough companies and tough founders. And that's sort of what I'm excited to see coming out of this as well. On an SVB perspective, we've huddled down sort of on a client first thing. We're still seeing deals. We're still looking at new things. We're on a selective basis, though. Again, higher bar. We announced a venture debt relief program for some of our clients. Anyone who had venture debt of 10 million and under, we sort of pushed it out for them by, I think, 6 months. We've seen, we've helped some of the clients go for the government programs as well on both sides of the border, so Canadian and on the U.S. side. We've been very busy over the last few months on client outreach, portfolio assessments. When they give us revised forecasts, what we usually see is people just want to survive 2020 now, as opposed to actually hitting those targets, just because the level of uncertainty and the level of effect. And at the end of the day, this is something that we've been encouraging, and that's something that I've been mentioned in the previous slide, which is open, transparent communication. Like, just talk to your peers, talk to your colleagues, talk to your loved ones, talk to your funders, your mentors, your advisors. Talk to people, try to understand different perspectives from them. If you're going to do something drastic like lay off some people, talk to people first. Talk to your peers first. Try to understand, is this the right move? Is it not? There could be an alternative that you just don't see. There could be a different means to kind of solve these issues, rather than pulling the trigger on the more sort of like drastic outcomes. And I think that wraps it. These are just links that talk about some of the different perspectives. They're a little outdated, but these kind of help you get the idea of what's going on in the ecosystem. Again, this will be shared with you, so you'll have all these wonderful links to kind of read from, and kind of like delve further into. Yeah, thank you.
Laith, that was fantastic. Thank you so much for going through the detailed overview of that. I've certainly learned quite a bit. One thing I would also add is look at your support systems, places like YSpace, places like the small business centers, Venture Lab within York region. There's DMZ in downtown region. There are lots of support systems out there designed to help you during this phase. So definitely look to them as an option as well. So why don't we maybe jump into a few questions, Laith, if that's okay. So MC, and by the way, if you have any questions, drop them in the chat or unmute your mic and feel free to connect with us. There's a question on the chat from MC. He asked, do VCs only look to invest or prefer to invest in tech industries? What are your thoughts?
Do VCs only tend to look into? Well, I mean, look. So you have funds that have. So look, when you're setting up a fund, you're essentially setting up a thesis that goes with it. So there's a whole sort of nuance that goes into it. Like when you're actually like bringing in LPs and you're bringing in sort of like the general partners and the partners to help like run this fund. Let me see if this actually helps. If I go, this kind of helps, I guess. Yeah. So I can jump between these two slides to kind of help explain that question. So the money that a VC has, right? So when you read all these news stories of like, fund XYZ raises, $100 million to do, blah, 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 blah. That's been raised from institutions, corporations, and high net worth individuals, right? It's raised from a combination of these three, probably, social security funds, sovereign funds, pensions, banks, corporations, you name it. The idea is that when you're actually putting together this fund, you're also building a thesis around it. So you essentially end up setting up a document called the LP agreement or limited partner agreement, right? This is a document that basically outlines how this fund will behave, how it will operate, where it is registered, who is in charge of this fund, how much equity the LPs have, how much return they get, all these different things. So it sets like the stage, the investment, the average check size. Like it sort of like sets the tone for like, all right, this is the fund and this is how it operates. So different funds have different LP agreements, obviously, and different funds will decide to invest in different areas. So you have funds that invest in sort of non-traditional or sort of like non-software style companies, and it's there's a whole group of them out there. It's just that I wouldn't really know about them, unfortunately, just because I've been operating in the technology side. But that doesn't mean that there aren't sort of investors in, let's say, more traditional style businesses. They definitely exist. It's just that I don't know where to find them. It's just that there should be investors in, let's say, clean tech. There should be investors in food. There should be investors in health, all that sort of thing.
Amazing. And if I could follow up on that, would you have any tips on how they could go about building out the prospect list, where they could go out and find these investors?
Sure. So the way I used to do this, so when I was building our lead list at the DMZ for investors to kind of go after, understand first off try to get a read on the specific sector that you're operating in. So your sector, your subsector, general industry, that sort of thing. And then try to figure out and try to find, I would go to like, your public databases of like your Crunchbases, your LinkedIn's, like that sort of thing. Start there, gather a few names of people who operate and invest in those who invest in those industries, sectors, subsectors, etc. And then you sort of start branching out a little bit here and there. Eventually, you will wind up with quite the large list by building names like name, adjacent name, that sort of thing, like adjacent to the industry, that sort of thing. Sorry. So you'll find someone. Let's say if I'm in agriculture specifically, I'm doing sensors for agriculture. So I would be looking at things like in IoT, agriculture, and then on a more adjacent thing would be probably like data or data insights, or if I'm doing machine learning with my sensors in in the agribusiness, I would look at people who are doing ML, and I'd try to look for a intersection of all three. And I'd also try and even approach sort of some of the companies that are already operating there, though carefully. You don't want them to kind of steal your secret sauce. And at the end of the day, also talk to angels. Don't underestimate the value of angels. Angels could be your most solid backers at the earlier stages, and angels could be anybody. For that, it's very hard to kind of track down and figure out who they are, just because angels are just wealthy individuals. You had one VC in the Valley sort of pitch to their optometrist when she was first building her VC. So it literally could just be like anybody who's willing to listen and who's willing to chip in money into your venture.
Excellent. those are some really good tips. So just jumping back on the chat, Aditi had a question. So is there a sample business plan which they can refer to for funding? It would help them map out the details. She had a few questions, so I'll let you answer that, and I'll jump into the two others.
Okay, so sample business plan, as in like a pitch deck, or did you mean like, or did you mean like one pager, or like did you mean like that's so? If it's a sample business plan, as in like pitch deck, there's tons of resources online, and I think basically everything we need to show the VC, that would be a pitch deck. Yeah, that's essentially a pitch deck. So if you go to, I'd say probably like one of the better pitch deck templates I've seen were the Y Combinator ones. So if you just go to Y Combinator's website, they have all the sort of like the tools and like templates that you would need. They're there, and then each slide essentially sort of highlights what you need to fill it with. And then happy to also look at your pitch deck later and sort of give you sort of feedback on it as well. So just like if you come up with a pitch deck and you're like, all right, I think I want to send this off to an investor, I'm happy to take a look and like sort of like review. Could you spell out the name of the website? Sure. So I'm just going to reply to everyone. So it should be. So if you just Google that, you'll probably find their website. I think it's like ycombinator.com or something like that.
Exactly. Great. And then I'll combine the two other questions. So what should they expect in terms of, I guess, contracts when they're engaging with VC funds? I suppose in reference to term sheets and all. And then the second of it is, what can they expect from a VC fund other than, just kind of the seed funding? Like, are there license deals? What are some problems that may come with the engagement with the VC firms?
Sure. Okay. So the first part is the terms. So we're going to talk about term sheets. You'll start seeing more sort of like stringent terms right now come into term sheets. So if we go to, I'm trying to find the slide. I think it is this slide. Specifically that last one that says the VC barbarians are coming. I love the title. It basically outlines like all the different ways that that VCs will now probably change, how they'll change their behaviors towards founders. So they'll either look for lower valuations, they'll either look to invest less. You'll have more protections for them in place should your company go bankrupt, or should there be like an exit scenario, or should there be a new round. There are going to be like a lot of different preferences that are in their favor, a lot of sort of like different sort of triggers in their favor. Those are things that you will start seeing. If you take a look at that specific link, I think it's, so if you look at that specific one, and if you look at, if you look at that specific one, that's where it will change.
Excellent. So moving into, Eric had a question. So should they take on a higher debt financing to investment ratio to preserve their cap tables?
Oh, before I jump into this, there's also the other part of their question.
Sorry about that. Do you want me to repeat that other part?
No, it's also like, what are they expecting besides the funding? Mm-hmm. They're like anything license deals, and then it's like, is there anything bad with it? So what to expect? So when you're doing research on a VC, so they do due diligence on you, right? So when you're actually presenting them with these business plans and everything, they're kind of researching who you are, as a person, literally looking into your background in terms of like skill, expertise, knowledge, that sort of thing, and experience, all that. And then they're also looking into the business model, the company, the market, all these different things. You should do the same to them, actually. The entire thing is, these guys are going to be on your cap table for the next like 5 to 7 years, maybe. And you want competent, valuable VCs on your cap table, right? You don't want people who will just cut you a check and then say, see you later. You want people who will check in with you frequently, You want people who will help open doors for you and make introductions to their partners, to their LPs as potential customers. You want people who will help coach and mentor you as you build your company and as you scale. You want that value, right? You want that operational expertise, and you want that business expertise as well, right? So you need to kind of make sure that who you're getting into bed with, essentially. That's the entire issue there. And then what to expect, sort of like downsides. They now own a piece of your company, right? And depending on what kind of investor they are, they might be aggressive and hostile, or they might be extremely helpful and amazing, or they might be completely toxic and just just not great people to deal with, or they might be like the best people that you've ever done business with ever. So it really could be like anything, and these are things that you should actually take into consideration. So do your due diligence. So yeah. So now the other question that Nafis, you're reading
Yeah, so let me just reread that for you. So Eric asked, in times like these, so as during COVID, should they take on a higher debt financing to investment ratio to preserve their cap tables?
If you can, sure. However, there's a limit to how much debt you want on your cap table, because that becomes a worry for VCs, right? So one of the things that we do is we try not to, SVB, when we're going into a round, we tend to try and stay below sort of like a 30% of the round as much as we can, just because you just don't want to own that round, and you don't want to be the major contributor to that round as debt. However, if you're able to kind of supplement yourself with your traditional sort of debt side of things, or other sort of non-dilutive grants or whatever, then go for it. Whatever amount you're able to kind of raise now that is not sort of equity based, do it, just because it's going down the equity side of things specifically now is just not a good, or it's not a great thing to do. Only do that unless if you run out of all the options. That's basically it.
Great, thanks for that, Laith. So Viraj from Lactiga, they're a Toronto-based biotech company. They're currently going through the FDA feedback process and looking into both the U.S. and Canadian market. So they were wondering, how's the funding activity kind of different or similar between these two countries?
How is the funding activity different?
Or just in general, what are you seeing?
So right now, generally, what I'm seeing is it's just there seems to be a stark divide between the way investors are approaching things in sort of both markets. You have some that are still looking at deals and still doing deals, and then you've had some that are just nope, we're just closing up shop for now and just waiting until this whole thing blows over. Mega rounds and the larger rounds are still those still happen. I think the seed and the Series A are what got hit the most. But we just see what's it called? We just see activity sort of continue as is, but on a slower pace, right? We're still seeing companies. VCs are still seeing companies. It's just that the doing deals has slowed down. That's the general trend, and that's the best trend that I can give you right now. Just because there's a lot of sort of stark difference. Again, it's stark differences between different sort of VC behavior.
Wonderful, thanks for that, Laith. So getting into Dhruv Kapoor's question. So speaking of early stage tech investment, what are your thoughts on the COVID impact on B2B and B2C SaaS companies that operate a recurring revenue business model? Do you often come across these types of firms approaching SVB for venture debt?
Yeah, I mean, we serve B2B and B2C companies. Just because when I was talking about our thesis, we literally deal with all sorts of software companies. So regardless of the business model, whether it's B2C, B2B, if it's marketplace, all that sort of thing. everyone got hit. Like that's like the problem. Like the problem is it's such a weird situation to see where like no industry was like sort of safe. I think one of the few industries that sort of like really did well were like the health and life sciences, or sort of like the telehealth companies, where they just sort of like saw a spike in sort of like demand. And another thing which actually saw like amazing spike in demand was Zoom, which we're actually all using right now. But then too much attention to Zoom brought its own fair share of problems. But then again, yeah, so I think most industries got hit. It's just been across the board. Because at the end of the day, we go back to this guy here. No, not this. We go to here. We go to controllable versus uncontrollable elements. So you can control what kind of business you are. You can control what your business model is, and how your unit economics work and all that sort of thing. If you're B2C, if you're B2B, you sell to this geography, if you sell to that geography, if you sell to these clients or not these clients, etc. You can't control where that client is operating and what kind of market the client operates in, right? So that's a very uncontrollable, very like variable point. So I think it just got hit everywhere, and we've seen. You've read, if you just go on BetaKit and you just kind of like look back the past like couple months, like you'll see even the big players, Ritual being one of them. I think Sonder was another one, and there was like a couple others that just like laid off like a large percentage of like their employees. Like it hit everyone regardless of size.
Absolutely, some really good points there, Laith. So jumping to Seb's question here. So what was Silicon Valley Bank's response to COVID-19 in terms of supporting the innovation ecosystem? Are there any specific funds or kind of new focus areas that you're seeing?
Yeah, sure. So what we did was we announced so almost immediately, like as soon as this thing hit and as soon as everybody started moving work from home, we shortly announced a venture debt relief program. You can read more about that on the news, sort of like on the news websites, where essentially all of our clients that had venture debt with Silicon Valley Bank for 10 million or less, we sort of gave them sort of like a relief period of up to 6 months, just so that they can hang on to that cash for a little bit longer and not have to like lay anybody off or do anything drastic. Again, this bank has been around long enough and through multiple sort of like downturns and through different sort of scenarios to understand and empathize with founders. So we sort of we get it. This is a bank where the DNA of a startup is woven into it. So we understand that revenue can be inconsistent. We understand that you can miss your targets. We understand that things can go sideways at the flip of a switch. And then especially when times get tough, we understand that too. So that's one of the things where we sort of like stepped in. The other thing that we started doing was we are basically our relationship managers and our heads for all the different sort of client management or portfolio management, started calling all the different sort of VCs that we work with and sort of talking with them about the status of their portfolio companies, specifically the ones where there is overlap between us and them. So if they had any portfolio investments that had raised venture debt through us, we were pretty much talking to them about those clients and making sure that, don't worry, you guys, we've got these guys, we've got this company's back. We're there to support, we're there to help you and help them with anything you guys need. So that's another thing that we've done. And then I think, what was the last part of that question? What have we been seeing, or what have you?
Well, I guess, are there any specific funds or new focus areas that you focused on?
No, I mean, still like we still look at everything. We're still looking at everything normally. Just as I mentioned, like towards the end of the presentation, it's still business as is. It's just that it's slowed down. There's no specific like industry that we're turning away from. I guess the industries that have been like hit the hardest are the ones that we're probably a little bit sort of like hesitant about. But it's not that we won't look at it.
Right. Excellent. So let's just take one more question from Anthony. So he is looking to start a connected fitness business, similar to something of a kickbox Peloton version. Can you elaborate on your comments on how to source relevant VCs and angels in his case?
Sure. Okay. So you're basically in the health and fitness. You're basically in health and fitness, right? So the entire idea is you want to look for key investors and key players in health and fitness, right? You want to look for, so angels are going to be tough because angels don't necessarily tie themselves to one industry, although sometimes they do, and then sometimes they don't. So you can kind of understand why on the angel side it gets a little bit confusing, and it gets a little bit murky. On the VCs, you essentially want to look for, so taking Peloton into consideration, look at who invested into Peloton first, understand their thesis. So let's say Nafis has a VC and they invested in Peloton. You go to Nafis's VC website, you try to understand the thesis they invest in and try to sort of tie that thesis or that sector that they look to and see which one actually fits in with Peloton. That's the industry that you're sort of targeting as well. Now you've got that key, you start looking for VCs that are also in that sector and that are in any adjacent sectors to that. So it'd be, for you, it'd kind of be, so it's like health, lifestyle, fitness, exercise, I don't know, like the fitness industry. Like I'm not sure on the taxonomy or like the terminology that goes with it, but you kind of get the idea where you're looking for like those specific like industries that are around it, and then you try to build a list of investors and angels that are around and that are tied to these terms themselves, into these keywords. So it's sort of like working backwards. So you go look at who invested in Peloton, you look at what they usually invest in, you try to match what they invest in with Peloton, like which key phrases actually tie to Peloton. You go find investors attached to those key phrases as well, and then you find other investors that are tied to those investors with regards to any deals that they've worked on together or any sort of like similar deals that have been invested in. If that sounds like a lot of work, it is, because like that's how you build a lead list. Eventually you'll wind up with maybe, who knows, like 100, 200, 500 names, and that's where you get started.
And there are obviously some really good tools also out there, like Crunchbase and Hotstick and all of that. AngelList, another really good one. So plenty of resources out there. I think it's just digging a bit deeper into the internet.
Yeah.
Yeah, just wondering, like I've been working on something that's in the product development space for health and fitness, stress release, like muscle tension release type product. Okay. And just wondering, like in that space, like what's the reality in terms of getting funding for going from prototype stage that I'm in right now with validation with customers and professionals right now to be able to launch like into the next stage.
Right. So in terms of going from product development to sort of like customer validation, you'd probably have to look at, well, who are your customers coming out of this? So basically, you have this product, you have this service, or you have this platform, etc. Who is this being geared towards? Are they actually able to use it now in this climate? The other thing is, in terms of distribution or sales channel, how can you actually get it to them? Or is this sort of a thing where you sell it to sort of health professionals and then they administer it to their patients or to their clients?
It's like a self-help type product, like targeting the self-help market in terms of being able to do it at your home in the absence of spending the money or getting access to a massage therapist or a chiropractor.
Gotcha. So it depends on the complexity of the offering itself. In that case, it depends on like, does it sort of like need any regulations? Does it need any sort of like licensing? Does it need any of that? If not, it becomes a whole lot simpler for you to sort of try and test it out with just like a select group of people. I'd say just start piloting it with with like a few friends, few close knit community members.
That's what I've been doing, right? Like
Yeah.
I've been meeting up with some people that are open to meeting that are chiropractors and registered massage therapists,
Okay.
as well as some close friends and family, right?
Yeah.
To get feedback on the product, confirm the
Yeah.
benefits, the design, getting some suggestions, and just working through some different design like changes,
Sure.
but getting ready for that next step. And I'm just
Yeah.
trying to look for the reality check on, hey, with what's going on and where things are heading, is this something that I can get funding for? To like, do I go the Kickstarter route, or are there other options out there that realistically would invest at this stage?
So I would say best bet right now is the angel route, angel grant route. VC route will have to see way more traction. Just putting it out there. VCs in general just want to see like more metrics there. Angels will probably be your best bet.
Sorry, what you cut out there?
Oh yeah, I was just going to say angels are going to be your best bet there. I would say if you can position this, or is this positioned towards being a COVID-themed product in the current format, or for the time being, like, i.e., has this been produced for the sake of, hey, out there it's COVID right now, here's what you can use to kind of like, to kind of supplement and sort of like help yourself.
Right.
I would target a few initiatives that are doing COVID response. So there are some programs here and there that are looking for COVID-related sort of startups. So if that's the case, you can go down that route. And there are actual COVID sort of themed angel groups that are now being set up. So these are angels that are looking to invest in startups that are aiming to tackle this environment.
Wonderful. So I think we're at the top of the hour, a few minutes past 2. Honestly, some really good questions that have been answered through here. Laith, what a fantastic session with you, and really super informative. Wishing you all a wonderful rest of the day, and thank you and take care.
Thanks for having me, Nafis. Thanks, everyone.
Thanks.